Check 1, 2.
Go! Curious about real estate? Yes! Then you've come to the right place. Get the knowledge you need. Get over the fear and get started. This is the Michael Quarles Real Estate Show with your host, Michael Quarles.
Hello, everybody. Michael Quarles with the Michael Quarles Real Estate Show. I have with me today Albert Berriz, and we're going to chat about residential multifamily. Now, I know I've chatted about it before, but I have never chatted with someone who has succeeded at it to the level Albert has. This is going to be an enjoyable conversation. I can already tell that I'm going to be a little frustrated with myself because I have arrived at a level that I enjoy, but it is certainly not. It is a long way away from the level that Albert has arrived at. And I need to get to work. That's all I have to tell myself. I've got to get to work. So I'm going to invite him in and let him talk with us and educate us on multifamily. Welcome to the show, Albert. Tell us about yourself.
Michael, thanks very much for having me on the show today. My company is called McKinley. We are based in Ann Arbor, Michigan, and we're a national business. It's a $4.6 billion family-owned, privately held business. And in that, we own and operate 35,000 multifamily units and about 20 million square feet of mostly shopping centers and some office as well.
Wait a second. So $4.6 billion.
That's correct. We are a national business, and we've been in business since '68, and my partner and I have been together since 1982.
That is, I have to say, that's a lot of money.
Well, it's taken us a long time to build it, and we've built it from the ground up. We've done it ourselves, and our focus has been, multifamily income-producing property, and that's our core portfolio. All of our assets are generational; they're financed long-term, and so, like a lot of your listeners, our focus is cash flow. So we don't have any other sources of income other than the cash flow from the assets that we own. And so we are, unlike others, we are old-fashioned owner-operators, which means we're very flat. We're in the field. Our family members are actively involved in running the real estate. My partner and I did that for many years, of course, and now we have a second generation that's doing it quite effectively. But make no mistake, we're an owner-operator. We're not a financial manipulator. We're not simply owning assets. We're producing the cash flow from the results that we make happen every day.
What was your first deal?
Well, my partner started the business in '68, and we started as student housing operators in Ann Arbor, Michigan, which is the home of the University of Michigan. So like a lot of people, we started with syndication funds. We didn't start with our own money. And we bought a building that was close to campus, and, we went from there.
So for those of us that are listening that may not understand syndication funds, tell us about that.
Well, at the time we didn't have any capital, so we borrowed money, if you may. We borrowed the equity from friends and from family. And in exchange, we gave them preferential returns. We gave them, advantages to their capital. And we took a carried interest as a result of our work because we didn't have capital in the deal. That was our starting formula for many years. About 1989, 1990, we switched and we really essentially got out of the syndication business because we had created sufficient capital to go on our own. And since about 1991, we have done all of our deals without any outside partners.
That's amazing. How large was your first property? How many units was it?
It was 12 units.
That was not my first property. Mine was only a single duplex. So you had me beat.
Well, I always tell people this single duplexes in our business, it's the very best way to start. In fact, I have a nephew who's in California, and he started and he's building a very nice portfolio. He's a lawyer by profession. And so what I tell people, what I like about the duplex as an example, and in your example, is you get to live on one side and you get to rent out the other. So, it's the hard work, it's the sweat equity, it's the producing the cash flow on the up, essentially the other side. And one of the great things about the business that we're in is that, the tenants who are living, the residents who are living in our buildings are essentially providing the cash flow. that will pay off the mortgage over time in the buildings that we own. So I love the duplex as an example. It's really a great example for people that are listening.
And very affordable for them. And you're absolutely correct. Now, from 68 to 1990, if I'm doing my math right, is that 32 years? No, 22 years.
22 years.
At what point in that first 22 years was the aha moment that you've arrived? You guys are successful. You know what you're doing. You're not afraid of real estate. And you just went for it. Was that in the beginning? Was that in the middle, towards the end of those first 22?
Well, I think we remain today, and we always were active owner operators, and so we essentially created our own destiny from the perspective that our results were either going to be good or bad, based upon our own work. The difference for us wasn't the operational excellence, because we knew what we were doing operationally. The difference for us was accumulating capital, and quite frankly, when we started, we probably didn't have any capital. We just decided to go because we wanted to have the freedom of not having partners. So for us, it was more a matter of independence than it was that we thought we had arrived financially, because we really hadn't. In fact, it was a very difficult time. In 1990, 1991 was a very difficult time in the economy, certainly in the real estate business. And, we almost went out of business because the liquidity issues that, for companies like ours were very serious, and there wasn't a lot of financing available in the marketplace. And as you know, it was one of the most serious collapses other than 2008 that's been, recorded in what I'll call recent real estate history. So for us, it was really more independence. We probably weren't ready to do it financially, but we did it anyways because we thought we had to do it at some point, and we did, and we just charted our own course. And we bought very little in those early years when we didn't have any outside partners, and we had bought a lot with outside partners because we just didn't have the capital to do it. But eventually the cash flow from the buildings that we owned, gave us more cash flow to be able to acquire more assets, and we grew quite substantially toward the end of the 1990s and certainly over the last 15 years.
What was the turning point for that substantial growth? Was it just the track record? Was the properties becoming free and clear, if they ever did? What was the turning point?
Well, for us, we have a very committed and loyal group of commercial banks that support us, and we were religious about paying them back. So what we would do every time we borrowed money to do a deal, we paid them back ahead of our expectations of when we were going to pay them back, and when we said we would pay them back, and that gained a lot of confidence. And so we went from having very few people willing to finance us to having a lot of people waiting in line and wanting to finance us. And so that switch, if you may, where our ability to prove what we did in the marketplace, in the financial marketplace, is really what changed the paradigm for us. And so, even today, our capital capacity and liquidity is much different. We pay back early. And so for us, having those banks supporting our ability to grow, and they fueled our growth, and they continue to fuel our growth, has been an essential part of our success.
Outstanding. I remember I think it was 81 or 82. It felt very, very comfortable because banks were competing for my business at the time. It was a different era of lending way back then than it is today. It was awesome. I wish that model of lending that we had was still here, but it left us, like some other things. Now, do you build your units or do you buy your units?
So our primary business is acquisition rehab. We're distressed buyers, but we do build as well. So in today's McKinley, we do three things. Essentially, we do build ground up. It's a small portion of our overall business model, but it's an important one. We build ground up in the exact same markets that we are operating in, so that we're adding to the critical mass we already have. We acquire, distress, and turnaround assets. And then we also acquire what I'll call a niche portfolio of historic rehabs that those are more core urban locations in downtowns that we have significant market dominance. So those are the three things that we're doing today at McKinley.
On the distressed seller, can you share with us how you find those opportunities?
Sure. No, I think part of it's market driven. So right now it's a terrible time to buy. We're out of the marketplace right now on what I'll call traditional garden apartments. Those 300 to 600 unit buildings that is the core of our company, because they're too expensive. And we expect things to change. So as an example, from 2009 to 2013, we bought 5,000 units in essentially 3 years. because it was a great time to buy. And so we were buying deals at 12 and 14% cap rates that are probably trading today at 4% cap rates. So that's one factor. The market's a big factor. And then the other thing is relationships. So we have great relationships, particularly in the banking community. And so when, those banks get upside down, which they will in tough times, we are able to move quickly, close very quickly, and liquidate and pay them off and be a resource for them, because otherwise they have, the distressed debt. So we'll buy debt, we'll buy buildings, we'll buy all of the above to get to the asset and eventually take control and own and operate the apartment building, in our case, forever.
In my industry of single families, one of our major prospect groups are hard money lenders for that very reason. They'll do a lot of lending in a period of time, and then all of a sudden that inventory starts going back to them, and they need their asset back, which is their capital, and they become a very, very good seller because they bought it right. So they don't have a lot of skin in the game, and they want that skin returned to them. So I imagine the banking is very similar.
It's identical. And your example of hard money lenders, of course, exist in multifamily as well. And by the way, there's a whole universe of people, and I just use banks as one example, but let's call it all of the universe of lenders that would want to liquefy. Just like in your example, they want to liquefy the home because you're correct. Their business is not owning and operating single family homes. Their business is controlling and lending out money and making a return. Right. So in our case, the same thing. And so whether it's a hard money lender, which we work with, for example, in our business as well, or commercial banks or life insurance companies, all of those people, when things are going south, would prefer to have cash than own buildings. And so whether it's in your case, the single family home, or in my case, the 300 unit apartment building, being able to close that home or close that apartment building quickly is a huge advantage. And you have the relationships, of course, and so do I. And so those are, in times like this, even though you can't do a lot of deals because the market's a little bit stronger, what you can do is really foster and grow and deepen those relationships, because there's going to come a point in time and you want to be ready to strike. There's
absolutely an ebb and flow to the market. And you're right. Those relationships, I think, are crucial. I'm constantly telling people to work I call it the center of influence, to work that relationship, because it will reward you. If I were going to enter the large multifamily industry that you're in, first three things I need to do.
Well, I think you need to develop a business strategy that is very coherent, very thoughtful, that is financeable. In our case, we only go into certain markets. We only acquire big garden apartments. We don't buy ultra luxury. And when we go into markets that are tertiary markets where they're major employers, they will never go away. So, when you speak to our lenders, they can repeat that business strategy verbatim, even though I'm not present in the room. So having that coherent strategy is not only important for you and your team, but it's equally important for raising capital. So that's number one. Number two is the team. And the team is actually more important than the real estate. And so in our case, we have a very committed team. We have a team that's been around a long time, family and non-family members that have been around for a long time. But they're pros. And so again, the access to capital, people know whatever we say we're going to do something, we actually deliver. So I would say team is two. And then, number three is, the quality of the assets. And so in our case, we have really focused on extraordinary assets and making sure that they're, able to last for the long haul. So, I'd say coherent business strategy is one, team is two, and the real estate three. And I really think the real estate's secondary to the team and the business strategy, because you can't do it. You can't do anything without great people.
So if we fall back to the market, what's the criteria, and can you share that for a market that you would enter?
Yeah, in our case, our cases are we're a large, national player, so our strategy is well known. So I'm not telling you any secret sauce that people don't know. Our lenders know and our competitors know. So, we have gone into what we call tertiary markets. Primary markets would be New York City, San Francisco. We don't want to go to those markets because our advantages of capital and expertise are crowded out, because there's a lot of people that have capital and expertise in those primary markets. We don't like secondary markets because that is a subset version of the same argument, but we really love tertiary markets. So if you take New York would be, let's call it a primary market, Dallas would be a secondary market, Orlando, Florida would be a tertiary market. Now it's growing, but it has been a tertiary market. So the players there are not the national players. They're not the national REITs. Certainly not the players that you find in New York City with that capital and expertise. So our core market is going to be a tertiary market. it's going to be a major employer that doesn't go away. In the case of Orlando, someone like Walt Disney World that has 65,000 employees in one single location. And we have a lot of buildings right across the street from Walt Disney World. So that employer isn't going to go away. And then lastly, in our case, we focus on workforce housing. We focus on what people call bee garden apartments. These are not going to be ultra luxury. These are going to be apartments where everybody living in those apartments, people don't have to wake up tomorrow morning and go to work. So our three-part strategy is that simple. It's really tertiary markets. It's, owning buildings across the street from major employers that will never go away, and focusing on people that are working at those employers, and they're not the ultra luxury housing, but in fact, what we call workforce housing, people who have to get up tomorrow morning and go to work every day.
Are there any industry types that you're afraid might go away that you won't consider from a market perspective?
Well, I think we do a lot of research on that issue. When you look at Central Florida, again, I'm using that as an example because, we're the largest landlord in what's called the I-4 corridor, which is the connection between Orlando and Tampa. The entertainment business today is, a global business, and people are coming from all over the world to Orlando. So, yeah, I think that that's, you have to be careful to make sure that, industries today can shift away from you, employers can shift away from you. But, it's over 220,000 hotel rooms, the single largest concentration of convention space anywhere in the country today. Three major theme park operators with Disney, SeaWorld, and Comcast Universal. So you have a base of tourist commercial infrastructure. No one's going to go out in, a neighboring state, let's all say Kentucky, all of a sudden going to build, a new Disney, a new SeaWorld, and a new Universal, 300,000 hotel rooms and, millions of square feet of convention. It's not going to happen. So, so you have some sense of why an employer isn't going to go away. And, in our hometown of Ann Arbor, Michigan, the University of Michigan, which is a public university, but it's financed essentially like a private university, has 45,000 employees. So that's a university that's a research university. It's a world-class university in terms of its educational status. So those 45,000 jobs that are in the medical center, that are engineering, that are teaching in that school, won't go away. So we've been thoughtful about making sure that when we make those bets, we're not sitting in front of a manufacturing company that decides to close up and moves overseas.
Well, I'm thinking like of, Detroit, where the auto industry isn't as good as it used to be, and owning a few thousand units there would hurt a little bit, I would imagine.
Well, yes, to your point, we were throughout Michigan in the 1990s, and we sold our portfolio back to Ann Arbor, which is the core University of Michigan portfolio, because we had lost confidence in the auto industry for the very same reasons. And so, we won't go back out into the broader Michigan today because we do think there's industry risk. We think that there's significant industry risk. And so the volatility of rents and employment in those businesses, right now, the auto industry is flying high, but it will hit a stop. And, we've seen it happen before in Michigan. So in Michigan, in our case, we won't own outside of Ann Arbor, which is the University of Michigan, just for that very same reason. But we're very insulated here because it's a very small town, 140,000 people with 45,000 employees, one single employer that will never go away. But that's not true for the rest of the state, and I concur with your assessment. We wouldn't take auto risk in today's environment.
I imagine that when you guys started your business, you couldn't even imagine dealing with the economics of your business today. Or did you sit back there in 1968 and thinking and draw this strategy out of research and determining what market to invest in and which market not to invest in, what factors would give you a thumbs up and keep you out?
Well, one, we had no idea. Two, I think, we defaulted to two markets that we knew well, which are Michigan and Florida, two locations we knew very well, because my partner and I are both very familiar with Florida and very familiar with Michigan. He grew up in Michigan, I grew up in Florida, so those were two natural markets for us to expand our business. But no, there's no way. In fact, as I said, we almost went out of business, candidly 2 times in that time, and we were probably out of business both times. We just didn't know. We weren't smart enough to know that we were out of business. And so, there's no way that we could have drawn that straight of a line. But what we were able to do, like entrepreneurs, is as we tacked along the way, found ourselves in a very different spot, and candidly, our significantly different level of capital and ability to be where we are today has been mostly in the last 15 years, if you want to track the whole history. So, I would say 2000 through 2015 is where things have changed. So, it took, let's call it 30 years to get to a place where we had a platform that we were able to then
the overnight success, right? The 30 overnight success. Yeah.
I tell everybody in this business, this is a slow-baked business. It's not a microwave business. If you think you can make a lot of money and raise the kind of capital that we have and liquidity that we have, and you can do it overnight, then God bless you. It's taken us 40-plus years.
Well, you can if you scratch off the right lottery ticket. Now, they did that a couple months ago.
Well, that's an angle. I hadn't thought about that one, but I'll give you that one.
Can you imagine winning $1.5 billion?
It's terrific.
I didn't buy a lottery ticket because I didn't think I was going to win. I guess I know I wouldn't if I didn't. But you mentioned team, the importance of the team. What do the team members look like? What's the staff size? What do they do?
Well, we're flat. So, I'm a firm believer of being very close to our customers. So we measure our distance from the number of heartbeats that I'm sitting at to, our customers that are paying us rent in the field. And so we're very customer centric, which means that when I say we're very flat, we are really owner operators. And so we have a very significant handle on the metrics of our business, how we're doing. We meet monthly on every single aspect of our business. We measure everything we do every single month. And so we are absolutely obsessive, compulsive, and maniacal about operating very well. Our buildings look great. Our customers are very happy. Not everybody can be always happy, but let's call it, in our industry, we certainly are leading. And one of the ways that we can tell you that is because our rents compared to our peers and our competitors are a delta or a plus to what theirs are. And so no one's paying us a difference unless we're better. So, it's a lot of hard work. So in terms of the teams, on the operations side, our apartment business my son runs, he's been with us a long time. He's learned the business from the ground up as a teenager. So he knows how to clean toilets and run apartments, and he knows what to do to run a large apartment business like ours and run it well. But he runs it with very few people. They're highly compensated. They're flat in the field. In other words, they live in the locations where we own our buildings. And, we spend a lot of time with them. So that's an example. But in every aspect of what we do, whether it's finance or property management, whatever it is that we're doing, it's very hands-on. And so we are a dinosaur in today's multifamily business because most companies like ours, our size, are public companies, and we're still, a family-owned, privately held business, and we do things ourselves. We're not delegating any way. We certainly don't delegate the management away. So I think in today's public company world, we are somewhat of a dinosaur.
What's the next vision? Where are you guys headed?
Well, we do the same thing every day. And so for us, it's, we don't need to go we don't need to be around the world. We need to be better every single day, and we need to learn how to be better. We firmly believe that we'll learn today something and that will make us better. We don't know everything, and so we set out to learn, and then we also set out to be better. You've got to get better every day. And so operational excellence for us is the core of our culture. And so for being better and learning are two component parts of our DNA and how we wake up every morning.
When you set out to be better and to learn, are you afraid of that failure word in that it'll keep you from being better or learning? Or do you look at it as something you tried that didn't work, you learned from, so you won't do that again?
For us, we don't have failure in our DNA. I mean, for us, we're entrepreneurs, and so we're iterative. So if we learn something and then become better, it's not a failure. Making a mistake is simply a bridge to a better place. And so, we made a whole bunch of them over the years, and some of them have been giant mistakes. And so, and I can give you a laundry list of them. So, mistakes aren't an issue, particularly if you're an entrepreneur. Mistakes are just a learning path, right? It's just a way that you just catalog, okay, I don't have to do that again, or maybe I'll do that a little bit differently next time. But that's just being a smart entrepreneur. And so entrepreneurs aren't worried about making mistakes. That's your education.
Boy, I sure hope a lot of folks listen to that statement, because there's so much truth to it. What didn't I ask you that most people do that you want to share that's important for the audience to hear from someone like yourself?
I think it's really important, and I really appreciate that you have this show, because I think it's really important that people realize they can start with a duplex and they can start with one single family home. And so my message is start, because there's no time like the present to get started, and it doesn't matter how small. If it's one single family home, get started. So I mean, my strongest message is no time like the present, and I think your listeners have a great avenue in your show to learn a lot of ways to get that going, and don't wait.
Yeah, absolutely. Don't wait. Well, I guess if you are a waiter, you serve food. So
there you go.
And I don't want to serve food. I appreciate the opportunity to say hello to you. I'm envisioning counting up to 4.6 billion. I wonder how long that would take. I guess it would take a lot longer if it was $1 bills over $100 bills. But I'm amazed that I'm actually chatting with someone who did it. So I appreciate the opportunity.
Well, it's my pleasure. Listen, again, I thank you for what you're doing. I think you're doing a great service to share all this educational opportunities and resources with all your listeners. And I thank you for the opportunity to be with you.
Thank you, sir. We'll talk to you soon.
Bye-bye now.
Bye-bye. Well, that was outstanding. I'm like I said when I started, I knew I was going to be frustrated. I do not have a business that has $4.6 billion in assets. I hope you guys listened and heard that man. He had a confidence about himself that wasn't arrogant, that wasn't belittling. It wasn't anything but awesome. That man knows what he knows. And that was enjoyable to have that conversation with him. I cannot imagine. It's going to go on my bucket list now. It is absolutely, I am going to change the amount of zeros I want in my lifetime. If someone else can do it, not that they're not special and extraordinary, but if someone else can do it, so can we. So you should go and revisit your objectives, what your goals are, what you want to accomplish. And if they are so low that you should adjust them higher, because you just heard a man without limit. That's pretty incredible. Hope you guys enjoyed that. I sure did. Until next time. Bye-bye.
Thanks for listening to the Michael Quarles Real Estate Show. Get more info and stay in touch at michaelquarles.com.